The idea is create an opportunity for renters to build wealth in real estate just by virtue of renting. This is a huge untapped problem in the country broadly, right? We have about 100 million renters, about a third of the country. They're spending about $650 billion annually on rent, and they're building no equity from that, right? It's just, you get living space, which is something useful, everyone needs it, but you're not building any wealth the same way you would if you had a mortgage.
Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. If this is your first time joining us, each week when you tune in, you'll hear one of two different types of shows. Sometimes when you tune in, you're going to hear industry news. That's where we pull up a few different headlines and we talk about what it means for the land development industry. Then other times we have an interview style show where we have on someone associated with the land development industry and we dig into some topics that are of importance to them. Now, today I'm excited to have with me Chris Lehman. He's the co-founder and policy architect at Groma. Chris, thanks for joining me.
Ryan, thanks for having me on. Great to be here.
Yeah, and where we always start on these episodes is getting a background of our guest and digging into a little bit of your origin story. And so it seemed like looking back at some of your history you had before you co-founded Groma is more, it felt like, on the policy side. And can you walk us through how you ended up getting into real estate, kind of your path to where you're at today?
Yeah, for sure. So background, grew up in the Boston area, went to school here, studied political science and economics in college, was looking initially at doing something directly in the policy space, whether in government or at a think tank outside of it. Ultimately, for a variety of reasons, ended up going to the private sector first to kind of build skills, earn some more money, and then continue to look for ways to get into a more policy-oriented role eventually. So I started out in the private sector working for a pharmaceutical consulting firm based out of Kendall Square in Cambridge, which is kind of the biotech capital of the world, arguably. We're doing a lot of data-intensive strategy work for pharma manufacturers, advising them on pricing strategy. Lots of work on complex systems with different parties, conflicting incentives, how to optimize systems to improve outcomes for everyone. Also, obviously, dealt with a big policy area being healthcare. Pivoted from there into tech, continuing to do a lot of data analysis and strategy work with large systems. So I was working at Wayfair, a big e-commerce company here in Boston, working in conjunction with the operational teams as well as the software engineering teams to build software systems that leverage the research my team was doing on how the incentives could be better configured to result in better practices for the operational teams. So got a lot of exposure to the tech and software development side of things there. And it was during that period, and this is 2019 to 2021, that I started talking with Seth Prebatch, a good friend from high school who I'd stayed in touch with. During the early pandemic period, lots of things happened, obviously. We were all shut off in our own little cloisters, and the Fed started up a lot of quantitative easing, right? Printing money, putting it into the economy to keep people paid, keep people happy while many parts of the economy were shut down. And we started talking about the future of money, what was going to happen as this kind of inflationary episode went on and as future ones came up going forward. And we started actually thinking about the nature of currency and how would one design a currency from scratch. At that time, Seth was starting to do a bit of dabbling in the Boston real estate scene, buying properties, operating them, et cetera. And I had previously taken a class with Professor Neil Ferguson, who was at Harvard, is now at the University of Austin, professor of financial history, gave a great background on currencies and how they've evolved over human history. And it was the kind of intellectual backing of that class and some other reading I'd done, as well as the ongoing observation of the real estate ecosystem and how currency was working under the current US system that led me and Seth to the idea of a currency backed by real estate as a really nicely aligned way to run currency going forward. And so we can explore that a bit in a moment, but that was kind of the inception of my involvement professionally with Seth. And that led the two of us to explore those ideas over the rest of 2020, We co-wrote the white paper in 2021, and then I joined full-time as policy architect after that. And so I deal with government affairs. I do a lot of the like long-term strategy and theory at the company, a decent amount of public relations, and a lot of research work as well.
Well, cool. Well, that obviously brings us to Groma. And so, for people who aren't familiar with Groma, can you describe what the company does and how you operate?
Yeah, good question. So Groma, there are a few different silos under Groma. It is kind of an opco-propco model, which I think is pretty common in real estate and real estate tech. We invest primarily in small multifamily real estate. This is a type of real estate that's very common in Boston and other dense cities around the U.S. We're focusing on 2 to 20 unit multifamily rental properties. So in Boston, that's triple deckers. You may have seen them if you've watched movies like The Departed or if you've lived around the city. And then there's similar archetypes in New York and San Francisco and Chicago and a lot of older cities. This is an asset class that has been neglected by institutional players pretty much for its entire duration, which is 100 plus years at this point, because these properties don't have the economies of scale that you see in larger multifamily, right, which is traditionally where the institutional investment has been on the residential side. And then it hadn't, as of when we'd started at least, hadn't had the kind of tipping point that the single family rental space experienced in the wake of the global financial crisis when prices cratered and larger firms came in to figure out an operational model that actually worked for single family rentals. So in kind of a similar way, the COVID pandemic depressed rents temporarily in a lot of big cities and gave us a bit of slack to develop some better practices for running these properties. So Seth and a lot of the rest of the exec and engineering team here came from Grubhub, actually. Seth had previously founded a company called Level Up, which was a payments company acquired by Grubhub in 2018, and then he led Grubhub's revenue and strategy for the next 3 years. And so they have a lot of experience building software systems for running complex operations involving many separate sites around a city, right? So in the case of Grubhub, that was restaurants. In the case of Groma, it's residential properties. And so we built out a pretty sophisticated tech system leveraging both AI agents and kind of traditional triage and routing algorithms to make it easier to run these small properties more efficiently and produce big operational improvements, both in terms of acquiring them efficiently, renovating them to a common standard, and then running them at a lower cost basis than the normal operator, which tends to be kind of a mom and pop operator. So that's the top level summary of the real estate side of the business, right? So we raise a lot of funds into that to buy properties. And so you can invest in the various real estate vehicles that we run. And then separately, but in a very integrated way, we're working on building out the financial technology on blockchain to enable broader ownership of those real estate assets, to enable them to plug into, say, the DeFi ecosystem, and then eventually to enable that currency functionality that I mentioned earlier.
Yeah, and that's the piece that I'm really interested in. I don't know how, of the people listening, and I don't know how many of them are familiar with this. I think most people in the industry are familiar with the traditional model of how they raise funds, they go out, they build they do a development, and then they sell maybe they're doing single family homes for sale, or they're doing build to rent and they're just managing it that way. Whereas I feel like this model, and I don't know if you refer to it, is it like a tokenized real estate? Is it I'm not sure how you refer to it, but I guess what I would be interested from your standpoint is, how would you describe that to people who aren't really familiar with how the concept of this works? I think it feels like magic to some people with how you're tokenizing these real estate assets, and then you're giving the opportunity for people to come in at buy a fractional piece or invest in a fractional piece of it. Could you describe that a little bit?
Yeah, absolutely. So tokenizing effectively means to represent some object in the real world, or not even necessarily in the real world, but some object as a artifact on blockchain, right? Blockchain is a distributed ledger, right? It enables people to keep a unified record, typically of transactions, that's maintained by disparate parties, scattered around the world. In many cases, don't even know each other, but because they're following a common protocol, they can agree on a common record of transactions, a ledger. And so In the case of Groma, the vehicle that is tokenized on chain is the Groma REIT, which is our REIT real estate investment trust. That's our evergreen vehicle. It co-invests in all of our other vehicles and is our largest and longest standing vehicle. And so the shares in the Groma REIT are represented on chain as fungible tokens. Fungible meaning that all of them are exactly the same. They're identical to each other. They're not unique. And so fungible shares represent the fungible tokens represent the shares in the REIT. We separately have non-fungible tokens that represent individual properties and record all of the unique characteristics of those properties. The shares derive their value from the value of the underlying properties. All of this is standard REIT stuff, except for the part where you're then tokenizing it and representing it on chain. Currently in parallel, though eventually we hope for the ownership records to actually exist on chain as well. But raising money for a REIT works the same way you would have it operate in any traditional REIT. Being able to invest in the REIT on chain is not itself massively different in terms of the fundraising model than it would be for a traditional REIT. Where things get interesting is where the REIT enables you to do novel, or the on-chain instantiation of the REIT enables you to do novel transactions that aren't really well supported by the traditional financial system. And so I don't know if your listeners are familiar with the concept of DeFi. DeFi stands for decentralized finance. It's essentially leveraging these on-chain protocols to enable people to lend or borrow assets that would typically be intermediated by a bank or some kind of other traditional financial institution. And so this is a use case for Groma Coin that we're very excited about it. That, to be clear, does not exist yet, and we still have some regulatory compliance questions to resolve that are moving very quickly in the broader world of federal digital asset and security policy. And we're kind of on the vanguard of that as we figure things out in conjunction with regulators and other players in the on-chain space. But once we have solved that, the ability to leverage the on-chain capital that's there will, we think, be really accretive to the REIT's value and to the utility that holders of individual REIT shares can get out of them. Now, I realize that was a little abstract. So to go into kind of a more concrete use case here, one of the products that we're currently developing and that we expect to be live for a wider audience at some point next year is something we call rentvesting. Rentvesting, portmanteau of renting and investing. The idea is create an opportunity for renters to build wealth in real estate just by virtue of renting. This is a huge untapped problem in the country broadly, right? We have about 100 million renters, about a third of the country. They're spending about $650 billion annually on rent, and they're building no equity from that, right? It's just, you get living space, which is something useful, everyone needs it, but you're not building any wealth the same way you would if you had a mortgage. And so this is exactly the kind of problem that financial systems generally should, in theory, be able to solve, but we haven't actually seen that happen, even though people have been renting for, hundreds of years in the United States. So the way rentvesting works is, if you're a renter, say you're paying $2,000 a month in rent, you instead of paying that directly to your landlord, you buy $2,000 worth of Groma Coin, the tokenized shares of our REIT, and we then lend you $2,000 secured against those shares. You use those $2,000 we lent you to pay your rent. So you're now in a position where you've paid your rent. That's the same as usual, and you now have offsetting $2,000 worth of REIT shares, $2,000 worth of debt. Net out to zero, but over time, you would ideally hope that those REIT shares appreciate. Not guaranteed, of course. Real estate can go down. That does happen. But we've designed the rentvesting program to make it as low risk and as simple as possible for the renter, such that if the value of the shares go down, that's actually Groma's liability, right? And so when the debt is eventually paid back, any deficit there is something we're responsible for. Now, of course, we're also managing the real estate, and so we expect ourselves to do a good enough job that it won't go down, that broader market forces will be, at worst neutral, and therefore our management will add value. Separately, we're also using the dividends produced by the real estate's income to cover the interest on the borrowed capital here. And so over time, you're the renter, your shares are appreciating, you're putting in money each month. Eventually, you may want to cash out, and then you can take just fully owned free the difference in the appreciated value of the REIT shares you own relative to the debt that you incurred while investing in them. And that you could use for a down payment. You could just continue to own the REIT shares and earn dividends from them. Lots of different ways you can do that, but the idea is without changing your consumption or investment habits or otherwise cutting into your lifestyle, you're building equity in real estate without really any effort aside from signing up and just being a renter. So it's a really powerful way for renters to build wealth, and we'll be again rolling that out in full next year. We're doing an internal alpha so far with team members and some early investors. Where blockchain comes into this, because we are currently for the alpha actually just running that on traditional financial rails. There is a lot of money in the world of blockchain right now that is in search of yield, right? And this has been a big struggle in blockchain, right? You had the early cryptocurrencies like Bitcoin and Ethereum that just provide equity, right? The value goes up, the value goes down, they're highly volatile. Over the course of the past decade, they've both gone up a lot. And so that's, been great for the early investors there, but they don't have organic yield. And so people have been working, especially in the past few years, to figure out ways to have stable assets that generate yield. And so you're seeing tokenized money market funds based on US treasuries that are providing that to some degree. Though again, you can to some degree run into questions around securities law and how that intersects with these decentralized systems. But having tokenized real estate on chain is, I think, for most people, a much more compelling source of yield and overall returns than what you would get from tokenized treasuries, right? You're still getting dividends in kind of the mid single digits, but then you have appreciation in the actual value of the underlying real estate. And so because the existing options for yield on chain are not especially exciting, at least from my perspective, we think we can probably get pretty competitive rates of financing for Rentvesting by staking the REIT shares, the Groma coin on chain, and then borrowing against that in dollar denominated tokens.
Okay, so making sure that I understand all this. So Groma goes out, buys a property. You have renters inside the property. So with the rent vesting, the idea is that the individuals or families that are in these, in these rental units or renting from you, they have the opportunity to, rent vest, where they would then be able to buy shares of the REIT through their payment that they're making each month, and then in theory be able to build up wealth, assuming the property actually appreciates, or through the dividends that you were talking about. Am I understanding that correctly?
Yeah. So a few things to note here. We're very excited about offering this to our own renters, right? People in Groma properties. We don't plan to limit it to Groma renters.
Okay.
You could be a renter anywhere in the country, even outside of the country, assuming you have the authorization to invest in U.S. securities, and still have it function basically the same way, right? The only difference being if you were our renter and enrolled in Rentvesting, we would just handle the rent payment automatically for you, whereas you would still have to go and give it to your landlord if we are not your landlord. But the goal is really for all renters in the United States to have the ability to enroll in this program and scale the REIT and build wealth for themselves. And also just to clarify, you mentioned dividends versus appreciation. The way Rentvesting is currently structured, the renter has exposure to appreciation upside. And that's basically it. We make the math as simple as possible for them. Dividends are, again, handled by us, used to cover the interest on the debt that's incurred to make this work. And then we also earn our typical, property management fees, asset management fees on that. And our bet is effectively that the sum of dividends and fees exceeds interest such that we make a profit on each individual rent investor. And so as long as that holds and the properties aren't losing value, we come out ahead, as does the rent investor.
Gotcha. And I know we want to get into a couple government policies and that have been pushed through. But before we get to that, I want to dig into one other thing on this topic we're talking about now. So for developers that are out there that are listening in, if they, again, they've maybe been doing the more traditional route of buying and developing and, renting out and everything. If someone out there wants to explore this, like maybe this is, and I know Groma's betting on this being something that's going to be big into the future and everything, assuming more and more of real estate goes this path, how can developers dig into this more to try to get an understanding of how they could potentially incorporate this into their own model and begin to do this with some of their real estate assets versus the traditional way?
Yeah, very good question. So the approach of tokenizing individual assets as opposed to broader pools of assets is something that has been tried, or that is in progress with various other on-chain projects aside from Groma. It was something we looked at, and we, obviously we're dealing with small properties, and so the unit economics of tokenizing an individual property for us would be very different than it would be for somebody who's developing $100 million property or something like that, right? Huge, residential or industrial. There are lots of useful things that you would be able to do if you were to tokenize, say, shares in one of those properties or the property itself, right? Being able to engage in these online lending, staking transactions. But a very important thing to keep in mind throughout all of this is that, and this gets to some of the policy side of things, tokenizing the ownership of these assets doesn't kind of like allow you to wave a wand and say the magic words and get around securities regulation, right? These are still securities. Groma coins are REIT shares, which are securities. And if you were to tokenize a single property, it's still a property that's being managed by you, developed by you. There is, collective effort of insiders that's behind the operation of the thing, and the outside investors are expecting to profit off of your work and the project that you're undertaking. And that's just straightforwardly a security. So I think there are some people, and this was maybe more common, 5+ years ago than in the past few years, who thought that the fact that you were issuing a coin on chain and that the ledger was decentralized meant that it didn't meet the bar for being considered a security, but that's no longer really the consensus, either with the SEC, even with the much more crypto-friendly SEC that we have now in 2025 than we did for the few years prior to that. So you still need to do all the same regulatory compliance, but the applications of being able to stake equity on chain in a way that's not intermediated, again, as long as you're complying with all of the securities laws, is a pretty compelling one.
Well, let's shift into some of the government policies that have been going through. We talked briefly on our last industry news episode. We dug into the Genius Act briefly. We're not experts on crypto or anything like that, but I think there's something there that would be of interest for our listeners to hear more about. And then I know you had mentioned when we talked before recording or chatted about it, Clarity RFIA is another one. Could you dig into the two of those and kind of talk about what it means for real estate and just the development community at large?
Yeah, for sure. So I'll start with Genius because that's the one that's actually been fully passed into law, right? Both houses of Congress signed by the president. Genius Act is the one that deals with stablecoins. So stablecoins have been one of the most successful applications of crypto in the real world so far, arguably the most successful application, right? Stablecoins consist of issuing tokens on chain that are backed by dollars or dollar equivalents like money market funds. So in many ways, it's similar to the role that's been played by banks, right? Banks, take deposits, issue money, etc. People have compared it, and I'll get into this more in a moment, to kind of the wildcat banking era of the 19th century, where you had banks that were kind of engaging in unrestricted issuance of their own bespoke currencies. I think there's good reasons that it's not really similar to that, but there are some superficial similarities. But stablecoins have been really in demand because they provide a lower friction way to engage in dollar-denominated transactions on chain than was previously possible. And B, as it relates to the international market, there are lots of people throughout the world, especially in developing countries, countries that don't have stable currencies of their own, who really want to be able to hold their cash in a relatively stable format. Now, we complain about inflation in the United States, right? Currently, inflation is like 2.7 or so percent, which is not amazing, but it's much, much better than the situations faced by many other currencies in other countries. And so lots of people want the ability to transact in dollars or something that is equivalent to dollars, and to be able to hold their reserves in that same asset. And stablecoin, but for whatever reason, don't have direct access to the U.S. banking system. And so stablecoins give them the ability to transact with what are, in most respects, equivalent to dollars, without actually having to jump through all of those hoops. There are still issues around compliance and making sure that people aren't using this for nefarious purposes. And big firms like Circle, which is the issuer of USDC, which is kind of the preeminent US stablecoin, are rigorous about their compliance and making sure that bad actors aren't using it. But bottom line is there's a huge demand for dollar-denominated assets on chain throughout the world. But up until this past July, when the Genius Act was signed, there was still a lot of ambiguity around what can be considered a stable coin according to US regulations, who's allowed to issue them, what regulations do they have to comply with, and especially what can you back them with. So, Circle, the issuer of USDC, has always been backing theirs with dollar-denominated assets. Other issuers have been incorporating kind of a more exotic mix of assets into the backing, hoping to get better yield, but perhaps resulting in less stability. And so the Genius Act basically laid out a set of requirements for, if you want to issue dollar stablecoins in the US, you have to have them backed fully one-to-one by liquid assets like cash, 90-day US treasuries, reserves of the Fed, et cetera. There has to be same-day redemption at face value, all the normal things you would expect from using regular dollars. And so by resolving that ambiguity, it gives stablecoin issuers the ability to issue these tokens at scale. They gain their own revenue based on the underlying yield-bearing assets that they're using to back them, and users get a stable, relatively frictionless payment experience. So that's genius. I know that was a bunch. We can talk more about the wildcat banking angle if you're curious, but I want to pause here, I guess, if you or your listeners have any questions.
Yeah, I mean, so you talk about the stable coin, and the stable coin primarily it's something of interest for other countries. One thing we talked about on the last episode, again, it was just us kind of speculating and just thinking through some of the things that draw people to crypto has been like you talked about with Bitcoin or Ethereum, the growth that they've had. Right, it's turned into more of an investment vehicle that has
Yeah,
increased. You're not going to be. You don't want to be one of those early people who bought a pizza with a Bitcoin or something, right?
right,
And
right.
end up seeing how much it's appreciated over time. And so
Yeah.
the stable coin obviously comes into play where it kind of prevents that, right? You put money into the stable coin to be able to transact with the stable coin. Is kind of the idea in the future that more people are going to be transacting via the stable coin versus the US dollar, but they're trying to wrap different compliance around it. And that's kind of what maybe the Genius Act starts to try to do. And I'm guessing there's still more that needs to be done with it, but this is kind of the initial phase of that.
Yeah. I mean, I think the aspirations of the big dollar stablecoin issuers would be to, take on a larger and larger percentage of the payment infrastructure in the United States, right? Which today is dominated, for the most volume of transactions by credit cards, right? Some transactions are, of course, still carried out in cash. Sometimes you'll do checks or a bank wire for bigger payments. But I think most everyday Americans use credit cards for most of their transactions, and that's a great experience for the users of the credit cards. But merchants have to pay often pretty non-trivial fees for that, and I think that there could, in theory, be a lot of demand from the merchant side once the technology is out there and the infrastructure has been built for a way to carry out those transactions where the fees are lower and the experience is similar in many ways for the actual user.
Gotcha. And and I know I'm jumping around a little bit here, but what do you think that means for real estate and land development in general? I mean, does it have a direct impact to that, or is it more of an impact to just society as a whole?
Yeah, good question. I wouldn't say that there's a massive specific impact for real estate and real estate development. I mean, I think you'll see lower transaction costs and more efficient payments for the economy as a whole, and so that applies to real estate as much as it does to any other sector. And so there's some incremental gain there. I wouldn't expect stable coins themselves to kind of radically transform business models in real estate. I mean, Groma as an owner and operator of real estate, we would love eventually for our rent to be paid in stablecoins, for the aforementioned payment and payment fee and convenience reasons, and then also because it becomes easier to kind of programmatically integrate that into systems like Rentvesting or whatever else we end up building off of our tokenized real estate shares. It's just because of the smart contract infrastructure that underlies a lot of the blockchain stuff, you can have more seamless integration of programmed business logic in all of these different elements of the ecosystem.
All right. Well, how about so the other one you had mentioned was Clarity, RFIA. I don't know. I'm probably not
Yep.
pronouncing the second part right, but could you explain that for us a little bit?
Yeah, no, and you're pronouncing it correctly. So Clarity is the House version, and then the RFIA is the Senate version. Clarity was kind of snappily named, as was Genius. RFIA is kind of just a normal abbreviation. So you just say RFIA. And so both of these are, two somewhat conflicting versions of what's called the market structure bill for crypto. And this is a it has been a huge area of debate in the crypto space for the past 5+ years, and deals with how are different blockchain assets labeled for the purposes of regulation by either the SEC, Securities and Exchange Commission, and CFT, Commodity Futures Trading Commission, and what rules and regulations apply to each of them. And so, helpful context here is over the course of the Biden administration with Gary Gensler as the head of the SEC, there was pretty significant hostility towards the crypto space coming out of the SEC and the presidential administration generally. And there's speculation about precisely why that was, and some people would say it wasn't really a genuine priority of the voting populace and was more of a function of kind of disciples of Elizabeth Warren having lots of highly placed positions within those structures, and Warren, for a variety of reasons, has been a harsh critic of crypto for a long time. But basically, you had lots of different issuers of crypto tokens who, with a wild range of different functionalities, some of which, by basically any definition would be considered securities, some of which by basically any definition would be not considered securities, and others of which were kind of in a more ambiguous middle ground. And what many of these people, at least the kind of more responsible ones, were doing were trying to get explicit guidance from the SEC under Gensler about how are you determining whether a given token is or is not a security. And there was almost no guidance, proactive guidance forthcoming from the SEC during that period. And instead, they would just kind of like bring down the enforcement hammer by, announcing a new lawsuit against a new company saying, this is an unregistered securities offering, or this is an unregistered securities exchange. And it was kind of a, difficult environment for all but the most kind of standard, law-abiding companies to deal with. And I guess maybe that's not the exact way to phrase it, because many of these companies were trying to be as law-abiding as possible, but were doing kind of novel things that existed in an ambiguous space, and were hoping to get advice on how to comply, but weren't given such advice. So, that's the background for why the crypto space has wanted a market structure bill, something done at the level of congressional legislation that exists at a higher level than the regulation passed by the SEC, which is itself authorized by that legislation and previous securities legislation, so that they can know, okay, if I do a token offering that has this precise characteristics and it's run on a protocol that's this decentralized and has these rules and the fees work this way, yada, yada, yada. These are all the disclosures. Is that going to be considered a security and be regulated by the SEC, considered a commodity and regulated by the CFTC? Or maybe it's a stable coin, in which case it's a totally different category, or some kind of novel extra thing that falls outside of those and probably requires further rulemaking. And so the Clarity Act, the House version of the market structure bill, which was passed by the House in July of this year, but has yet to have anything passed similar on the Senate side or be signed by the president, is very similar to the market structure bill from the previous session of Congress, which was called FIT 21. And so, again, its purpose is to delineate regulatory authority over crypto assets between the SEC and CFTC by creating a new asset category called digital commodities. And so digital commodities would be exempt from standard securities regulation and would fall under the CFTC's authority. And whether something qualifying as a digital commodity requires some degree of decentralization in the protocol that results in these commodities or in these tokens being issued, right? So too much centralization and it becomes a security. And this goes back to the Howey test, which comes back from the mid 20th century about orange growers in Florida and kind of the combined effort of third parties resulting in the expectation of profit, right? So if you have too tightly coordinated and organized of a group of insiders who's issuing this thing, then that becomes a security and is subject to all the security regulation. But if it's kind of a more pure, decentralized, protocolized version where you don't have insiders with disproportionate influence or disproportionate actual holdings of the token, then it counts as a commodity and is subject to commodity regulation instead. And if it's more centralized, at least outside of a early probationary period where there hasn't been enough of an opportunity for the public to actually buy into this thing, then it's a security and then it's subject to normal securities regulation under the SEC. RFIA, the Senate side of things, is similar in a lot of ways, but differs to some degree in terms of how exactly it defines a digital commodity. And so this is where, basically the big difference is the RFIA does not care as much about the decentralization of the protocol that results in the issuance of these tokens. Instead, it focuses more on simply the degree to which they provide the owner with debt or equity interest in the project, dividends, liquidation rights, that kind of thing. So it's much more focused on the financial side of things than it is on the centralization side of things. And broadly, it's a much less detailed piece of legislation than Clarity. And so it's unclear exactly what's going to happen between these two similar but conflicting versions of market structure. And it's unclear, if any market structure will pass Congress this year or if it gets pushed off further to the future. But that's the current state of things.
Does it feel like the most likely outcome from this is that most assets that get put onto the blockchain will be regulated by the SEC?
I'm not sure I would say that. So
Okay.
for instance, the two biggest blockchain assets today are Bitcoin and Ether, right, which runs on the Ethereum protocol. Bitcoin, I think basically anybody, including even Gary Gensler, would say it is not a security, right? It's decentralized. There's no kind of centralized human-based structure that's running it. It's a digital asset, probably a digital commodity, and will not be regulated by the SEC. Ethereum is maybe slightly more security-like in that there's a Ethereum Foundation that is involved in making some programming decisions around it, but it's still a highly decentralized system, and likely, if I had to bet, ends up getting classified as a digital commodity. I think many other projects I wouldn't necessarily be able to say like X percentage are going to be securities and Y percentage are not, but there's lots of different approaches to centralization, decentralization, and the economics around that could result in different scenarios. But I think broadly, more decentralization and less centralized charging of fees makes it more likely that something's not going to be considered a security and therefore plausibly a commodity. And I should also mention, even if we don't get a market structure bill out of Congress in the near future, Paul Atkins, the head of the SEC today, has pretty strongly indicated his intention to proceed with rulemaking at the agency level, with normal kind of comment periods from industry participants, even if that doesn't happen, which would still end up in a better and clearer regulatory situation than what we have today.
Okay. And the reason I was asking is I'm kind of thinking through, people out there who may want to explore this as something, trying to maybe modernize their approach, or as this becomes maybe a little more mainstream. I would assume because they may tokenize an asset, there it's more centralized control,
Yeah.
because they're controlling it. Therefore, it is going to be something regulated by the SEC. That's not going to change. It's going to be
Mm-hmm,
very
mm-hmm.
similar to how it works today when they raise funds for an existing project.
Yeah, yeah. I think it would be pretty difficult to issue tokens backed by actual real estate that don't end up being securities.
Right. Okay.
Real estate needs somebody to manage it, and assuming it's not like some totally synthetic product, it's probably going to be highly dependent on the actions and discretion of the management group, and so would therefore be a security.
So a lot of this we've been talking about at the federal level. How do you think the states are going to react to this as far as, um, not having maybe as much control over some of these decisions? Do you think different states are going to try to step in and say that they should have some control over this?
It depends on which side of this you're talking about. States don't have a huge amount of latitude in terms of securities regulation. There is state level securities regulation, and that has some impacts, like most corporations being registered in Delaware. Some movement to like Nevada or Texas. REITs typically are registered in Maryland, and this is often a function just of like the body of case law that has built up in these states. Um, as it relates to securities regulation broadly, I think most states are unlikely to attempt to build out really detailed, comprehensive sets of regulation, just because there's a significant probability that it gets, preempted by government rulemaking at some point, or also just because I think many of states don't have the necessary expertise in their legislatures to do this, right? New York, obviously, a huge exception here, probably California, probably Texas, maybe some others. But I think more of the legislation that might happen related to blockchain at the state level would have to do with the non-security side of things. So, for example, like LLC registration, and how does that relate to decentralized organizations on chain, or deed registration, right? Which is actually something we worked on a little bit here in Massachusetts. Registries of deeds are pretty old school in a lot of ways. It would be nice to have a lot of that information more automatically accessible and transparent and composable the same way that most other things on blockchain are. Um, I don't think there's a huge amount of desire coming from registries at this point to undergo that kind of modernization process, though it's conceivable that legislatures could, give them a mandate to do so, and then they would move more quickly. We would love to see that, and it's something we'll probably spend more time on going forward. But it's not at the top of our list right now.
Yeah, I know that would be something that the developers would love to see, just
Yeah,
because
yeah,
that's
absolutely.
a big part of the land acquisition process is, yeah, digging into those deed records and everything.
Yep.
Well, we're at about 43 minutes here, so let's jump into the last segment here, and then we can wrap up. So last segment is what I call the lightning round. So I've got 5 questions for you, just related to a lot of the topics we're digging into here to get your thoughts on. So first one is, what's the biggest misconception people have about crypto and real estate?
Biggest misconception about crypto and real estate? I mean, I think the biggest misconception is that it fundamentally changes the economics at the project level. You know, we are doing our business model is different mostly for non-crypto related reasons as it relates to the actual real estate operations, right? We have a really good tech platform. We have a really good AI agent that makes us able to run these properties more efficiently. But those gains in efficiency are mostly being driven not by crypto. Crypto provides us the ability to build a layer of financial tools on top of that that ultimately will be a much larger portion of our business's focus. But I think for the average real estate operator, the amount of upfront costs and development and R&D that goes into that is probably high enough that it outweighs the benefits you would get from doing that.
All right, next one. If tokenized real estate takes off, what part of the industry will change first?
I would not be surprised to see a big change in the roles of various intermediaries, right? There's tons of intermediaries in real estate, whether you're just talking about like, when you're a homeowner, you have to go through all of these like title and deed issues, insurance, et cetera, right? It's all very manual. There are huge fees. I think you could end up seeing a lot of kind of automation and preemption of that. So, it wouldn't have to be done via crypto, but I think we're moving in that direction regardless.
All right. Do you see tokenization as more of a financing tool or more of an ownership tool?
I think the role it can play in financing is more immediate and more compelling. If you wanted to, for instance, hold your deed for your house in an on-chain format, you could do that. It wouldn't massively change how things work for most people, but I think access to a more decentralized, frictionless financing system is probably the most relevant side at this point.
All right. Fourth one. What's one thing land developers should do now to prepare for this shift?
That's a great question. I think familiarize yourself primarily with what sources of debt are available on chain, right? Especially with the increased prevalence of stablecoin based lending on chain and the different expectations around yield on chain, that could potentially be a pretty significant boost to the economics of some projects.
All right. Last one, more of a personal one for you. If you weren't working in real estate or crypto, what would you be doing?
Good question. Probably something related to government or law. My role here at Groma is heavily oriented towards those areas, and I think that there's lots of ways in which our existing government and legal systems create incentives and structures that are not working as well as they should be, and holding a lot of people and systems back, and working on changing those in some capacity, whether in government or in some kind of outside private group would be my instinct.
Perfect. Well, what's the best way, Chris, for people to connect with you and learn more about Groma?
Yeah, great question. So, I mean, you can reach out to me at my email, chris@groma.com, if you want to talk to me directly. Separately, we are about to have our waitlist open up for Rentvesting. So, probably by the time this is live, if you want to email rentvesting@groma.com to sign up for that waitlist, if you're a renter, to be clear, you can do that, and that's a great way to get involved with our ecosystem.
Cool. Well, hey, I really appreciate this. Something we haven't really dug into before on the show. It's definitely, there's some technical nature to it, right? For a little bit challenging, I think, for people to understand how this is all going to play a role in the industry and how it might change things. But I think this was really helpful to get people kind of headed in that direction. And so really appreciate it. All you guys who are listening in, the links that were just mentioned there will be on the show notes page. So if you look in the description, you'll see a link there to the show notes page, and you'll see a link to the website for Groma and also the email addresses that were mentioned as well. And also, last ask for all of you listening in, don't forget to hit that subscribe button if you're not already subscribed. And otherwise, we will talk to you all next week.